The video game industry was estimated to be worth 178 billion in 2021, which is an increase of 14% from 2020. The industry has been accelerating steadily since 2016, when it was forecasted to grow a total worth of 90 billion for the same period. This is a 76% difference between estimated and actual growth, which is testament that we could see further growth moving forward. Some forecast the industry to be worth 268 billion by 2025. Some of the main players in this industry include Nintendo, EA, Sony, Tencent, Epic Games, and Activision Blizzard. Today, we will take a look at Activision Blizzard, their business, the risks they face ahead. We will take a look at their financials, competitors, and valuation. So without further ado, let's dive into it. Activision Blizzard is an American video game company based in Santa Monica, California. The company was founded in July 2008 and is traded on the Nasdaq stock exchange under the ticker symbol ATVI. The company joined the S&P 500 in 2015. Activision Blizzard currently includes several business units: Activision Publishing, Blizzard Entertainment, King, Major League Gaming, and Activision Blizzard Studios. The Activision Publishing division develops free-to-play and premium offerings. This includes the Call of Duty franchise, which, as we will see later on, makes up a large portion of the company's revenues. Activision Publishing generates revenue from in-game sales, or sales realized while players play video games, and full game sales, which is when players pay for an entire video game. The Blizzard Entertainment division develops premium and free-to-play offerings. The main franchises are Blizzard Battle, World of Warcraft, Hearthstone, and Overwatch. The business unit generates revenue from in-game sales, full game, and subscriptions. As we will see later on, the company is transitioning to a subscription-based model, which is obviously more sticky than the traditional full game sales model. And lastly, the King Digital Entertainment division develops free-to-play games. Main revenue source comes from in-game advertising, Candy Crush being their crown jewel. Activision Blizzard works in a B2B and B2C model, as they sell both directly to consumers and also to businesses such as Walmart, Google, Apple, and GameStop. Main customers include Sony, which accounts for 70% of the revenues, Apple, which accounts for 15% of the revenues, Google, which accounts for 14% of the revenues, and Microsoft, which accounts for 11% of the revenues. Top franchises include Call of Duty, Candy Crush, and World of Warcraft. All three account for 76% of revenues. These are certain implications that we will see later on when comparing Activision with Tencent, which is one of the main competitors. Activision's business model is less diversified and more concentrated in their top franchises, but it also involves less cost of goods sold, as they don't have to constantly come up with new video games. Activision's growth depends on continued success with the franchises mentioned and also with new developments. When it comes to revenues by sale type, about 18% of revenue comes from point in time, which is products being sold and delivered, and 80% from overtime and other revenue, which is in-game purchases and subscriptions. This is really good, as it shows that Activision's business is becoming less seasonal and more recurrent. Now, there are certain risks associated with the business. The most publicly relevant one being an internal discrimination scandal, which caused the stock to drop 12.5% in July 2021. Essentially, the California Department of Fair Employment and Housing announced it was suing Activision for discrimination and sexual harassment. This was followed by work stoppages on its major game franchises, employees going out on a one-day strike, and fans calling for a boycott. Afterwards, the company released its earnings, and although they beat analysts' expectations, the stock went lower. Is the market overreacting? Activision has been growing steadily during the last few years, with revenues growing from 4.6 billion in 2015 to 8 billion in 2020. There have been some hiccups in between, but overall the company is growing and is expected to climb to 9 billion the next fiscal year. Cost of goods sold is increasing accordingly and at a much lower rate than other competitors like Tencent. This is probably due to the fact that Activision's business is concentrated in 3 franchises, as we saw before, which creates a little moat for Activision as their profits are higher than other competitors. We can't obviously compare Activision mode with other popular ones like Coca-Cola, since they have to keep innovating by releasing new features of the top franchises. But names like Call of Duty and Candy Crush have become very recognizable brands amongst consumers. Similarly, Activision's net income has grown from 800 million in 2015 to 2.1 billion in 2020. One point of concern for Activision is that they have been issuing new shares, diluting shareholders' value across time, although they have reduced the share issuance lately. When it comes to debt, Activision's situation is simply spectacular. They have a total of current assets of $10.5 billion. These are assets that they expect to realize in the next 12 months, while the long-term total liabilities account for $8 billion, which means that they could handle a financial crisis quite well. Activision's return on equity is about 15%, which means that they are doing a great job at using their available resources to generate returns. But how does Activision compare to Tencent, one of the main competitors? Although Tencent has been growing much faster, as you can see here, gross margins are almost double for Activision. This is probably due to the fact that Tencent relies on more than 100 video games to generate revenue and have to constantly innovate and create new content to grow. When it comes to current assets versus total liabilities, both Activision and Tencent are in a great position, but Tencent liabilities are growing much faster than Activision's, putting Activision in a much better debt position. Now we will take a look at 3 different business valuations for normal, pessimistic, and optimistic scenarios. I am using the discounted cash flow model. If you're interested in learning more about this model, let me know in the comments below and I will create some content to walk you through it. As for assumptions, I'm using a growth rate of 12.5% since we want to beat the market and get better returns than the expected for the S&P 500 index, which will be about 9% per year, and growth rates of 2, 5, and 7% respectively for each of the scenarios. With a normal growth rate of 5%, we can expect a 12.5% return as long as the stock drops below $52, which is not the case since it is currently at more than $60. If we drop the expected growth to 2%, which is our pessimistic scenario, we would have to wait until the stock drops to $37. And for the optimistic scenario of 7% growth, we could buy the stock and get a discount rate of 12.5%. I prefer to be conservative in my investments, and although I like the stock, I only have a small position in Activision since I think it would need to drop more for me to operate with a sufficient margin of safety. What do you think? Do you hold gaming stocks in your portfolio? Please subscribe and like the video if you enjoyed the content, and see you in the next video.